Well, it finally happened. For the first time since this tightening cycle started by the Fed, we are hearing signals of potential future easing for the first time. The FOMC had their meeting yesterday and today. The FOMC statement happened today. Powell answered some questions, and in this video, I'm going to give you the main takeaways that matter. What is the Federal Reserve doing right now? What are they planning or signaling, hinting at what they're going to do in the future? And why are markets rallying as a result? Ready? Let's dive in. Really quick, just in case you weren't aware, my portfolio allocation mastery course is available for pre-order right now, and during this first week only, you can get 60% off. I've got it on sale for pre-order just for this first week. It'll never be this cheap again. Again, that's 60% off for my portfolio allocation mastery course, teaching you how to bulletproof your portfolio to survive and thrive through these crazy economic times. All right, the Federal Reserve has hiked interest rates by 75 basis points. That's 0.75% for the federal funds rate. That's the base interest rate that all the other interest rates are based off of. Now, they did this last time as well, and this was the consensus estimate on what the Federal Reserve would do in terms of how high they would hike, and they met expectations. Now, many investors were probably caught off guard because typically over the last few months, every time they've hiked, especially 75 basis points, you'd take a look at the markets and they didn't do this. Gold is up 1%. Silver is up over 2%. Bitcoin is up 7%. The S&P 500 is up almost 3%. The NASDAQ is up over 4.5%. Dow 1.5%, Russell 2000, 2.5%. So markets are reacting extremely positively to this news of the rate hike. And then we also saw yields drop on the 2-year and the 10-year, while yields increased on the 20 and the 30. So we're seeing a steepening of the yield curve here. So an undoing of that inversion or of that flattened yield curve, just a little bit, not a bunch, but just a little bit. So why in the world are markets reacting like this? Well, it wasn't because of the 75 basis point hike. It was because what Powell said about the future of monetary policy. If we take a look here, we can see one thing that Powell said that was very, very important that not a lot of people are focusing on. He said, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Just so you know, this is the very first time since the tightening cycle has begun that has started signaling future easing. Remember how long this takes and how far in advance they like to give markets the ability to anticipate what monetary policy will be doing. They signal this stuff way in advance. Remember how long they were talking about, hey, we're not thinking about raising rates. We're not thinking about it. Now we're thinking about it. Now we're planning on doing it soon, but not yet. And then they finally started doing it. So since the beginning of this year, they've been saying, we're going to continue to raise rates. We're going to continue to tighten. We're going to continue to fight inflation. This is now the first time where he started that advanced signaling saying, hey, we're probably going to stop raising rates so quickly at some point in the future because they're seeing the data come in. Yes, the job market is still tight, but he signaled there were indications of slowdowns in the economy saying, hey, there are these little signs of weakness here and there. And so he mentioned the housing market and a few other things. So he's saying basically, look, like we know that we're starting to see the economy roll over. We don't think it's a recession yet, but we are anticipating we're going to have to slow down our hiking soon. So this is what I think I'm going to start calling dis-tightening, because it's not easing yet. This is what I'm calling dis-tightening. So we all know inflation is when prices are going up, right? Every month. So last month prices went up by, let's say, $10. This month they went up by $8. Next month they go up by $6. It's still prices going up, but that's what's called disinflation because the amount at which the prices are going up is decreasing. And so this is what I'm going to call dis-tightening because it's not yet easing. It's not that rates are going down. It's not they're adding assets to their balance sheet. They're just reducing the rate at which they're tightening. So maybe they go from 75 basis points. Next time it's 50 basis points for the next one or the next couple. Then the one after that, maybe they raise rates by 25 basis points for the next couple. I don't think they're going to start easing yet, but they're signaling, hey, we are going to start pulling off the gas here for how fast and how hard we're tightening, because we don't think that the economy can handle that. In the post-meeting statement, they also cautioned that recent indicators of spending and production have softened. And so they gave another indication saying, hey, look, we know there's still forces contributing to prices going up, but we are starting to see some forces that could start pushing prices down. And if they see the inflation numbers, the year-over-year inflation numbers start to come down, and they start to see that, again, that disinflation, how right now it's at 9%, next month 8%, month after that 7%, month after that 6%, they're going to say, hey, we're going to stop tightening so aggressively because we're starting to get inflation under control. Now, you know my opinion on this. So number one, all of that is descriptive, right? I'm not being prescriptive there. I'm not saying this is what the Fed should do. I'm not saying that they've made good decisions or bad decisions here. This is just what they're doing right now and what I think they're going to do. Now, what I think is happening right now is a rug pull on the economy, because we have a lot of deflationary forces like interest rates going up, debt getting more expensive, incomes dropping, spending power dropping. We're seeing a lot of economic pain show up. We're seeing a lot of layoffs start, hiring freezes start everywhere. So we're seeing a lot of economic problems show up that are always a result. They always come about during the bust phase. So we have a boom that's followed by a bust. The boom is always caused by monetary expansion, because the money supply expands, filters throughout the economy, prices go up, people feel rich, so they start to spend, but they realize, hey, that wasn't actually sustainable because it was built on debt. Monetary expansion was always built on debt. And so then things start to collapse on the other side because you didn't create any more wealth. You just changed how that wealth was measured. People are poorer after that. They can't afford things, and things start to crash after that. So we're entering into that bust phase right now that the Federal Reserve has been going full force into tightening mode into that bust phase. And so by the time all this tightening hits the economy at the same time as prices have started to collapse, I think we have a big amount of economic pain ahead of us. But one thing that we will probably see right around that point is a reversal in monetary policy. The last thing I want to point out is the reverse repo rate. Well, first, let's look at what they said about the reverse repo rate. If we look at this Fed statement, we can see they're going to conduct overnight reverse repurchase agreement operations at an offering rate of 2.3%. So the Fed funds rate, again, is 2.25 to 2.5. So every single time they've raised rates, they've also raised the reverse repo rate so that it sits at a 0.05% higher than the bottom of the range of the federal funds rate. And so 2.25 is the bottom of the range of the Fed funds rate. 2.3 is now the reverse repo rate. So that will continue to keep cash inside the reverse repo facility and continue to suck cash into that and out of the market. So this is risk-free money. You give it to the Fed, you make that 2.3% risk-free, and it is completely liquid. And so at any moment when financial conditions get too tight outside in the economy, when let's say bonds go no bid or T-bills go no bid, or there's not enough liquidity in the system, a problem happens, boom, they drop this rate down to, let's say 0 or 0.5% or whatever they want. And that $2 trillion then has to flood out into the bond market here and buys up 2-year treasuries, buys up T-bills, and forces yields back down, makes conditions a little bit easier, puts liquidity back out into the system. And so that's going to be the one thing that I think they're going to do before they actually ease, before they do anything with the Fed funds rate or their balance sheet, or increasing their balance sheet again. But it is significant that we are starting to see the Federal Reserve signal, hey, easing or a pivot could come, or dis-tightening could come at some point in the future. This is the first time they've started talking about that. So we still have tightening ahead of us, but now we see that they're starting to signal, hey, there's a light at the end of the tunnel, right? More free money to go around at some point soon here once the pain starts to hit hard. Hope that makes sense. Let me know if you have any questions in the comments section below, and I really appreciate you guys. Thank you so much for watching. Have a great day.